Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, June 7th, right before the close this week. Well, in terms of indexes and movement this week, I know you can look on your computer screens or hear from multiple people what the markets did, so I'm going to go in a different direction. Sometimes we like to talk about how we're positioned and psychology in the market, and I just want to touch on those pair of things and then get into some of the international markets, which we rarely touch on. We talk about breadth from week to week, and sometimes that gets confusing to people. When we talk about breadth, it's just how much demand is there for broad stocks versus narrow stocks. How do we track that? Well, we track that in the S&P 500, the cap-weighted index versus the equal-weighted index. Remember, the cap-weighted index is weighted per capitalization and is dominated by companies such as Apple, Microsoft, Amazon, NVIDIA. You know those names. Equal-weighted, it's the same 500 companies, but one stock, one vote. Gives us an idea of where money is going and how to position assets. Let's take a look at a chart. This is a rolling 3-month performance spread between SPY, which is the cap-weighted S&P 500, and RSP, the equal-weighted S&P 500. What we like to do is try to gauge, are we getting overextended in either area? How can we position assets to make money? What I like to do is look at 5% outperformance over a 3-month rolling average. As you can see, if we look to the far right, we're starting to approach that SPY outperformance over the equal-weighted index. So in terms of new money or positioning, we may consider fading the cap-weighted index. Not automatically. Let's see if that turns back down. One of the things I wanted to discuss today is anchoring, because I've heard numerous times over the last decade analysts, portfolio managers, traders talk about equal weight and how it's going to come back into vogue and how you have to be positioned there. By the way, we're positioned in some equal weight. So I'm not talking about a all or nothing bet on in either direction. When I talk about anchoring, let's go back to 2009. If you look to the left on the chart, you're going to see a spike down towards negative 20%. What does that represent? In that 3-month rolling period, equal weighted outperformed the S&P cap-weighted index by nearly 20%. That was such a severe number, such a number imprinted on traders' heads, on portfolio managers' heads, in the minds of people that are responsible for making allocation decisions, that it still sits there. I know it sits in there with myself. It's sometimes difficult to get past a big event in the market and realize the market may not go back to that. Now, never mind 20% outperformance of SPY over RSP or RSP over SPY, but that severe event affects how people go forward. And we battle that day by day, week by week in multiple markets. Psychology is so important in how you treat your money. And being able to recognize that past events are affecting how you think today in the market is so important to becoming a successful investor, a successful trader, a successful analyst. So I just thought this would be interesting because we hear that so often. I'll see somebody saying, this market's in trouble because breadth is horrible. It's a cap-weighted index. The equal-weighted index is weak. We're going to roll over. That doesn't have to happen. History shows you that markets can adjust. Just because cap-weighted is outperforming doesn't mean it can't pull back. Doesn't have to fall apart. Markets don't have to fall apart. So just recognize that going forward. Let me jump over to international for a moment. We had fireworks internationally. You saw a election in Mexico, an election in India, really affect the equities in both areas. We had some Mexico weighting, some allocation there, about a 4 or 5% allocation to Mexico in the form of EWW. Was down Monday after the weekend results, 7-8%. Probably got the luckiest trade we've gotten all year. We didn't sell into that weakness, felt it was a little oversold. Lo and behold, Mexico rallies for 3 days, makes up a good portion of that drop, and we sold that yesterday. Probably sold that within a tick of the weekly high, EWW in the 62.80, 62.90, 63 area. Excellent trade. Why do I mention that? Sometimes a trade where you're taking a small loss is the best trade you made all week. India, another story. India down, different scenario. This is a security that I've been trading in an outstanding trend with good, strong relative strength. Decided to let that trade a little bit. Got plenty of demand after that first pull down. We're still long India. We didn't trim. It's now made up its losses just about for the week. That does not mean we will not trim going forward. I don't like to take sudden drawdowns and not believe that this security will have trouble going forward. So we'll play India day by day, may just trim, but in terms of how we position that, we're going to let some of the relative strength lead us. So just some of the ideas we look at on the trading desk in our analyst meetings. We're trying to identify where money can be treated best over the next 3 and 6 months on the short scope, and then longer term if those 3 and 6 months are working. It's a progression, it's a progress. David Kotak has a commentary coming out this weekend talking about Mexico and India. Take a look. It'll be on our website and in our email blast. And now we're going to shoot over to the Moose, who's taping remotely this week.
Hi, it's John Mousseau. I'm the CEO and Director of Fixed Income at Cumberland Advisors. It is Friday afternoon on June 7th, and this is the bond report. This week, bond yields down across the board, but the numbers don't tell the whole story. And just to kind of put it in perspective, you're looking at a 2-year bond unchanged at a 487, a 5-year Treasury down 6 bips to a 445, a 10-year bond down 7 bips to a 443 from a 450, and a 30-year bond down 10 bips to a 455 from a 465. But that's not the story. The story was yields were much lower earlier in the week. For example, that 10-year bond at one point closed at a 428 a few days ago. So that's up a lot. 5-year bond was a 430. It's now a 445. What was the shift? The shift was today, where we saw a jobs number which surprised a lot of people, right? The number was expected to be, 180, came in at 272. That is a big surprise. What that did was it offset some more bond-friendly numbers earlier in the week. So, for example, earlier in the week, we saw the JOLTS number, the Job Openings and Labor Turnover Survey, come down, and that's continued to come down. We saw pending home sales come down. We saw jobless claims go up. All that till today changed the narrative. And then what's been the narrative? The narrative has been, how long will the Fed wait to lower short-term interest rates, which as the Fed funds at 5.25 to 5.5. When the market thinks it'll be a while, they'll take longer bond yields up, saying that they need to reflect what the higher rates are doing now. When they start to build in rate cuts coming, they'll take longer bond yields down because they think they will come down once the Fed starts cutting rates. It has been this tug of war now basically since the end of last fall, and we continue to go through it this week. Muni bond yields this week down across the board, basically 11 or 12 basis points. 30-year AAA scale is a 384. That's down 12 bips. Of course, stuff trades much cheaper than that off the AAA scale. But the important thing to remember is that bond deals continue to be very well oversubscribed. And that's important as you go into the summer months here. And right now, particularly, the calendars are somewhat light as we go forward. So I would expect on a relative basis, muni bonds, which kind of got kicked in the shins a little bit last month, to probably be okay on a relative basis going forward. I think one of the real stories out there, again, continues to be are people continuing to pile into municipal bonds because they think there's a change in tax policy coming with the election. We'll know at some point. We hope everybody has a great week. We hope everybody tunes in and watches the Belmont Stakes this weekend, the last of the Triple Crown on Saturday afternoon about 6:40. This year it's being run at Saratoga Racetrack because there's a big makeover going on at Belmont Racetrack in New York. And I still like Sierra Leone, who came in second by a nose in the Kentucky Derby, being driven by Flavien Prat. So that's my pick.
Thanks, John. If any of the commentary that John covered or I mentioned earlier in terms of analytics and things we look at are interesting to you and you want to discuss further, give us a shout. Enjoy the Belmont. Look out for D. Wayne Lucas. That's my man. Have a nice weekend.